Welcome to the Point Podcast. We have informed, intelligent conversations about today's financial topics submitted by viewers like you. Let's go ahead and get started. Here are your hosts, Landis Wiley and Alan Wallace.
Hello, and welcome to The Point, sponsored by Basepoint Wealth. I'm your host, Landis Wiley, sitting here as always with Chief Investment Officer Alan Wallace. Welcome to Season 2.
Exciting.
Of the podcast. So, Alan, it's getting to be spring outside.
I know, it's beautiful.
Weather's heating up, so's the market.
Mm-hmm.
A lot of volatility out there. Mm-hmm. So, we're looking forward to the topic today. Obviously, a lot going on in the world between elections, policy, news headlines, market volatility, globally as well as here in the U.S. So I'm sure the topic today is going to be riveting.
All right.
So looking forward to it. So format here, Season 2, very similar to the past. We have a topic, and we're just going to sit here and banter about it. And hopefully it'll be informative to those of you out there that join us and enjoy hearing what we have to say about current events. Before we get into today's topic, though, we always kick this off with a brief segment called The Most Important Thing. So, Alan, what is happening in the world today that, of all the things, that would be the most important thing?
The most important thing right now is credit spreads. This is more in relation to their usage as an indicator and less to do with their absolute value. Credit spreads were also featured in episode 10, but the importance was in their small stature and on our refusal to take on credit risk given the paltry compensation. Given the recent market correction, there have obviously been questions about the potential extent of a market decline. While we have no ability to predict the future, if this correction is going to deepen by much, we would normally expect a widening of credit spreads to reflect the increase in risk inherent in holding credit risky assets. Credit spreads have been remarkably steadfast throughout this entire correction, which has seen the S&P 500 drop by almost 10%, and the Magnificent Seven has dropped by almost 20%. Typically, we would expect to be heading into a recession if this market correction were going to get much worse. But if we were heading into a recession, we should see credit spreads blow out 300-plus basis points. The one exception to this rule is 2000, which saw credit spreads hold relatively steady even once the recession had started in 2001. This was probably a function of the recession being caused by market correction instead of the other way around. It is important to note that there are many changes in direction during a market correction. This is the very definition of volatility. We will not know when it is over until well after the fact. All we can do is buy when things are cheap, continue to manage risk, and maintain adequate liquidity. We will be watching credit spreads for signs that another leg down is forthcoming.
Imagine the perfect swing, the satisfying sound of a golf ball landing on the green. Your retirement could be filled with moments like these. At Basepoint Wealth, we design retirement plans tailored to your passions. Whether it's perfecting your game or simply enjoying the tranquility of the course, we've got you covered. To tee up your retirement with one of our fee-only advisors, visit basepointwealth.com to schedule your initial consultation today. Because from here, you can go anywhere. Basepoint Wealth is a registered investment advisor. Visit basepointwealth.com for important disclosures.
All right. Well, thank you for that, Alan. Obviously, it's going to be something to watch carefully, see what spreads do, maybe see what it indicates going forward as far as markets. So, so with that, welcome back, and thanks again for joining us. Like we said in the intro, a lot going on in the world. There's a lot of different things I'm sure people are curious about, and certainly, questions coming into the advisors at Basepoint, that kind of come along with these cycles. It's a fascinating time. So let's see kind of what we're talking about here today. So topic that came across, which I'm sure is on a lot of folks' mind out there in the midst of the ongoing volatility within the U.S. markets and the uptick in headlines. But the question that came through had to do with the difference between U.S. and international investment.
Okay.
And so the question was, U.S. stocks have outperformed international stocks by quite a large margin since 2010. So for well over a decade here. Why would we want to hold international if U.S. stocks have been the outperformer? Okay. So that's our question.
All right.
Obviously with the ongoing market volatility based in the U.S., maybe we should just start off with, sort of framing what's actually been going on over the last couple of months in those two markets. So, talk a little bit. Let's start with what's happened in the U.S. markets. There was sort of the peak in markets late 2024, early 2025, S&P, Dow, NASDAQ, kind of the big markets that everybody tends to follow. And since then, it's, the year started off kind of volatile. We've had a recent pullback in most of those markets, but it's kind of interesting how it's happening, which I'm sure we'll get into. What's been going on internationally, though, while that's happening?
So the international markets are down slightly, but not nearly as much as the U.S. markets, of course, and that's over the last couple of weeks. I think year to date, most of those markets are probably still showing positive returns. It just depends on where you're looking, right? So in the U.S., the S&P is down 5% or so year to date. Peak to trough, it's down about 10%. Well, early in my career, that was just standard operating procedure every year.
Right.
We've gotten kind of spoiled over the last. 20 years ago, we would have expected this to happen at least once a year. So we're not at the point yet where we even think that this is just a garden variety correction at this point. If you look at something like the Magnificent Seven, that's down almost 20%. So that's technically a bear market in the Magnificent Seven, but index wise. At this point, we're just back to where we were a few months ago. It's not like we've rolled back the clock to 2021 and we have generational prices. Although, if you've never been through corrections in your investing career, maybe this feels like a big deal. But and as we said, in the most important thing, we'll be waiting for credit spreads to sort of confirm whether or not this is a real, true bear market correction or whether it's just a little bit of volatility in the markets.
And to your point, it's been quiet in recent years in terms of volatility. Some of the recent intraday or day-to-day declines in the market, we most recently saw in 2022.
Right.
So that's coming up on 3 years ago. And to your point, there's lots of history that says that these things used to be normal on an annual basis.
Right.
So we've gone 2 or 3 years, which in a way isn't that long ago, but it also seems like forever ago. And I think people, to some extent, maybe have forgotten what that felt like.
Yeah.
And sort of a dovetail off of 2022. 2022 was similar in the sense that the Magnificent Seven, the big tech, were hit harder than the broader market. And so far, that's kind of what we're seeing, right?
Yeah.
In the U.S.
Yeah. The big difference between today and 2022 is that, bond yields aren't going up by 400 basis points. Yeah. So in 2022, it was almost impossible to be, diversified if you had intermediate to long-term bonds and S&P 500 type assets, right? Because you took the brunt of the correction in the Magnificent Seven or whatever they called them back then. It used to be called the FANGs. I don't remember when that changed, but and then also if you had intermediate and long-term bonds, you took a 20% correction there, which we sort of avoided by being in cash. If I look at our returns this year, we're still positive year to date, and that's on all the assets at Basepoint. That's not anyone's individual account.
Right.
But we're still up about 1% year to date, which is obviously like 600 basis points above the S&P 500. And our security selection is really good too. If you look at what a class blended benchmark of our allocation would be, it's down 2%. So we're actually picking up 300 basis points just on security selection. So, but again, at this point, this is nothing white knuckle yet.
Right.
So I'll be just sort of waiting to see if prices get to a point where we say, hey, it's time to reallocate. We're never going to say, hey, it's down 20%. That means it's on sale.
Right.
We're always going to be looking at earnings yields, and we're going to be looking at that as a function of 10-year treasuries, right? So if I could put together a portfolio that's giving me 2 to 3 times the yield on the 10-year treasury, I don't really care if the market's going to go down more or not, because over the next decade, I'm going to have good returns, and that's what I'm focused on right now. I'm not trying to call a bottom or call an inflection point for where we're going to start going back up. That's just, I've been doing this 25 years, and that's a fool's errand.
Right. Now, most of the allocation that you've held in recent years has been primarily focused on the U.S. domestic, at least on, and we'll get to the bond side and sort of the interest rate component of this. But starting with the equity side, you've been primarily focused in U.S. markets in recent years, and which is kind of tying into, I think, the question here, which is, okay, if the returns and the stability or the predictability or the confidence has been in U.S. domestic markets over international, where does international fit into your view in current market dynamics as well as kind of going forward from here?
Sure. So I had almost no international from like 2012 until I want to say 2020, 2021, where we started adding it back. And that was purely based on valuation, right? I mean, we were getting paid more, I felt like, to invest in the U.S. And it just so happens that period of 13.8 years is how long the U.S. has outperformed international. And so we weren't holding international for most of that time period. Now, just to prove that I can't see the future, I started buying 4 years ago. So, that outperformance continued, but now it's at the point where it looks like that's about to shift. And there's always been this cyclical relationship between foreign and U.S. stocks. I mean, it's decades, right? So it's impossible for the average person to, be patient for 10 years when it comes to investing. But we've studied 5,000 years of market history, so 10 years is just a blip. And so the reason why we would add international now is because it's cheap in comparison to the U.S. Right. If you look at the PE ratio, it depends on if you're looking at forward or backward looking, or what earnings number you're looking at. But the PE ratio of the S&P is somewhere around 27, 28. At least it was before the correction started. It might be a little lower now. If I look at Europe, it's 14. If I look at Japan, it's 13. If I look just at the entire rest of the world, it's in the 14 to 15 range. So almost half the PE ratio of the U.S. market. Now, you don't need much of a head start in order to get some outperformance there, right? Right. And history has also shown that the mean reversion is a real force in finance. When something gets stretched well beyond what you would expect it to be at the mean, there's typically some mean reversion. And, this international U.S. relationship has shown itself to be cyclical over 10 to 15 year periods going back to the 70s. Right. And so we're in another one of those periods right now. And so, we were 0 to 10% international for the last couple of years. Now we're looking to go to 10 to 20% international. So we're actually increasing so contrary to what the questioner is asking, we're actually, accelerating our international exposure right now, not reducing it.
Well, it's kind of the old fundamental investment strategy. It says buy low, sell high.
Exactly. Yeah. I mean, when something outperforms for 14 years, there's a tendency for it to be, absolutely overvalued or relatively overvalued in comparison to the thing that you're looking at. So, and then there's also some structural things going on, right? Like, Germany just announced that they're gonna spend $1 trillion. Well, that's going to go to companies in Europe, and so Germany's always sort of been the responsible party in the EU. They've got the third biggest economy in the world, right behind the U.S. and China, and they use debt very sparingly. But then, we've had some sort of transfer of responsibility in Ukraine from the U.S. to Europe, and to their credit, Germany has sort of stepped up and said, "Hey, we're going to start rebuilding our military and our industrial base, and we're going to help rebuild Ukraine." And that has put pressure on their interest rates to the upside because they're going to be borrowing money. But that should actually be good for their companies, right? Sure. And we saw that here. Yep. We took a bunch of debt. We ran big deficits, and what did it do to our stock market?
Right, sent it to the moon.
It did, right? So so you've got that going on in Europe. Japan's been sort of perennially cheap since 1990, right? When it was 40% of the world's market cap, and that's just sort of been burning off over the last 30 years, 35 years. So everyone's always saying Japan is cheap. So the biggest concern that we have is the political environment. Right. So, U.S. is the largest economy in the world, 30-ish trillion, and China is second at 20. The problem with China is it's still a communist government, and if there's ever any sort of economic war between us and China, the first thing they're going to do is start confiscating capital, right? So we're sort of leery about investing there just because we can't guarantee that we're going to be able to get our money back. So we are avoiding China to a great extent, but we're adding a lot of exposure to Europe. We're adding emerging markets for the first time in 15 years. And the emerging markets are even cheaper than the developed markets. I mean, you're looking at 12 times earnings instead of 15. So it doesn't necessarily mean that the companies themselves are as risky as the economies that they operate in. I mean, we use a value-focused fund that, buys based on price in relation to value in emerging markets. And so we expect that to be one of our highest returners over the next decade.
True. So you kind of touched a little bit on the political dynamic that's going on. So, as you're looking at just the current headlines are really focused on tariff policy.
Right.
And obviously anytime that you're deploying investment assets overseas or into overseas investment, you run into questions around currency and exchange and international trade policy and so on and so forth. What do you feel the dynamic in the current environment? What do you feel the dynamic or the risks are of picking up additional international exposure while all that is going on? Or is it all just noise?
No, I don't think it's noise, but I think we're going through a period of deglobalization. Mm-hmm. And when we globalized, it sort of made all these things correlate with each other. When we deglobalize, we should have, that correlation should break down. Mm-hmm. And, what's one of the first rules of investing in diversification, right? Is to pick up assets that aren't correlated to each other, right? And so this deglobalization should see us move away from the correlations that we've seen sort of hold steady over the last 20 or so years.
Right.
And again, it's easy to say, hey, the U.S. is going to slap tariffs on and we're going to damage the rest of the world. But what if we don't win? Mm-hmm. So right. The thing is, if there's an economic battle going on, we want to have exposure to both sides because we can.
Right.
We're not trying to pick a winner here because we don't know what's going to happen. Mm-hmm. So that push for deglobalization, the push for more military spending in Europe and infrastructure spending in Europe, and some of these economies trying to get away from dollar supremacy. Mm-hmm. These things all lead me to say we just need to have a little bit more non-U.S. exposure.
Well, and wouldn't there be a good argument to be made that if there is going to be some level of decorrelation between the different asset classes and the different asset exposures globally versus domestically, wouldn't that decorrelation effect kind of emphasize the importance of being aware of relative value in investing in different parts of the globe based on changing dynamics? I mean, our industry, I think, over the last, 20, 30, 40 years has sort of become sort of have a little bit of everything all the time. Mm-hmm. And, sort of hope it works out. That's maybe sort of masked inefficiencies because everything just kind of moved in the same direction at the same time.
Right.
But if what you're saying is the potential where we may start to see distinct differences in the performance or behavior of investing in Europe at this point versus 5 or 10 years ago or 5 or 10 years from now versus Asia versus China versus emerging market, does that kind of put more onus on this idea of, paying attention to what you're buying and where you're buying it?
I think you should always pay attention to those things, but sure, it becomes much more important when you've got, 100% delta in, valuations between U.S. and other parts of the world. Keep in mind, the U.S. is 4% of the world's population. Mm-hmm. It's 26% of the world's GDP, and it's between 60 and 70% of the world's market cap,
right? Depending
on what day it is and whose report you're looking at, right? Mm-hmm. So how could 4% of the people in the world have 70% of the stock value? Mm-hmm. I mean, to me, that sounds like it's overvalued.
Right.
And so we're just trying to get exposure to economic activity in other areas. Mm-hmm. And we want to continue to follow our discipline of remaining concentrated and remaining small and nimble, and always being valuation focused. But we also want to gain exposure to areas of the world economy that we don't currently participate in, especially when the U.S. is so artificial intelligence centric. Mm-hmm. We go through this every 20 or 25 years where we have some sort of boom and it's focused on an area. The last one was the .com thing. And now we're sort of focused on AI, and you've got the 7 biggest companies in the world all fighting over AI. Well, there's simpler things out there, especially in other countries, that are just good businesses that kick out good returns.
Right.
And they're not so focused on, the future being perfect.
Mm-hmm. And you made mention in there about, part of the focus, particularly on the European side, is Germany Germany's recent comments about spending more, right? And how that's likely to eventually flow its way into their companies, which would bolster stocks theoretically in Europe. As part of what we're looking at here, the undertone of the U.S. government on the flip side, seemingly trying to take the approach of spending less, and reducing our $2+ trillion deficit, and wouldn't. So if Germany spending more potentially bolsters stock returns on the European side, is there a case to be made that reductions in government spending domestically would have that inverse effect then on the U.S. stock market?
I think we've made that case here, right? So and you got to keep in mind, there's a lot of people out there that would say, well, why would you do that? It's going to make your stock market go down. Well, the stock market isn't the most important indicator in the world. When you're trying to reshore production, when you're trying to change the distribution of concentration of wealth, you're trying to reduce the tax burden on the citizens,
the inflation burden.
The current administration has been very clear that we could see some speed bumps here. And when they're saying that to you directly, you should take that to heart.
Yeah, most politicians aren't known for telling people, hey, your stock portfolio might take a hit.
Yeah, so they've been pretty clear that, the stock market is not our primary concern.
Right.
Our primary concern is Main Street. We want businesses to return here. We want more, small businesses. We want more production taking place here. And I think that that's a noble cause. And we all need to decide whether, hey, is the juice worth the squeeze here? And it may be over a 20-year period, but over 2 or 3 years, it might feel pretty bad. And again, we might have made it to the first inning. We were at the national anthem last time we talked about this. I think maybe now we've worked our way into the first inning. But this is why our discipline is so important, right? We're not trying to predict what the stock market's going to do. We're just trying to buy companies at good valuations that are going to compound on their own by becoming more valuable.
Regardless of where they're at.
Yeah, exactly. And the statistics that we look at tell us that, it's time to start branching out a little bit, to other countries and other economies.
So touching on, I think most people generally, and some of it is just because we're surrounded by it in the news, we have a fairly, I think, reasonable understanding of what's going on in the U.S. And if this happens, maybe the stock market will do this or interest rates will do this. You mentioned in passing earlier Japan. So as you branch out, and I think, as Americans, we tend to look and feel like we understand Europe, right? It's sort of another Western nation, very similar in a lot of ways to the U.S. But then we go to Japan. Japan, you touched on, they've been unique in a lot of ways, economically and fiscal monetary policy wise for the last 20, 25 years, in the sense of trying to hold their interest rates ultimately low. Very, very close to zero. I think they've had negative interest rates even
for a little while.
At a couple of points in there. One of the things that's popped up in conversation around just the global economic situation that's happening is what's called the Japanese carry trade. So, I guess, what is that? Because I think as we're talking about, do we continue to focus capital investment in the U.S., whether that's U.S. bonds, U.S. treasuries, U.S. equities, what have you, or do we branch out internationally? What is that carry trade in Japan, number one? Because I don't think most folks probably don't have a good understanding of it, right? The nightly news anchor uses the term carry trade, and then they move on, right? And nobody really explains what it is. So first of all, what is it? Why is it important? And ultimately, what could be the impact not only to this concept of impact to maybe markets if we were to begin, putting dollars into, say, Japanese stocks or Japanese bonds, but also what's the potential impact to the U.S.?
Sure.
Based on a carry trade scenario.
Well, so a carry trade is when you borrow in a currency with low interest rates and you buy in a currency with higher interest rates. And so, Japan's had their interest rates at the zero bound for years. And so for hedge funds, or insurance companies or anyone else, it's easy to go in Japan, borrow a bunch of money, convert that to dollars or some other currency, and buy securities in those other currencies, it's a really cheap form of leverage. And then you collect the difference in returns between what you're paying in Japan, which is almost nothing, and what you're earning in the other currency, which, is 4 or 5%. Right. You lever that up 15 or 20 times, and, you're talking some real returns.
Free money.
Yeah, exactly. And so the issue is, did that carry trade, which, no one knows how much it is because there's not like a ledger that says here's all the carry trades. Mm-hmm. The estimates are anywhere from 4 trillion to, I've seen 20. I mean, is that true? I don't know. I have no idea. But let's just say at the lower end, there's $4 trillion in debt outstanding in Japan that has to be paid back. And in order to pay that debt back, they're going to have to sell securities in the U.S. or Europe or somewhere else. Mm-hmm. Most likely the U.S. And it's probably things like the Magnificent Seven, mm-hmm. right? When you've had that sort of outperformance for 10 years, it's easy to say, I'm going to borrow this free money. I'm going to buy these stocks, and I'm, going to make 10 times my money, mm-hmm. And I think people have tried that. I also think maybe some of that money has found its way into the crypto mm-hmm. currency area. So the problem is that now Japan is raising their interest rates because inflation has finally started picking up there. Mm-hmm. In 1990, everyone thought Japan was going to take over the world, right? They were catching us in GDP. And then all of a sudden they just sort of hit a top mm-hmm. and they haven't recovered since.
Right.
And so now we're finally, I think, maybe reaching that consolidation phase. But people have been buying Japanese stocks for 20 years saying this is finally it. And it just hasn't ever happened,
Right.
But the issue is that now that Japan is raising interest rates, it's making that loan that people took out, the free money, mm-hmm. much more expensive.
Yep.
So they have to sell their assets in order to pay the loan off. And in the middle, convert the currency back into yen, right? Mm-hmm. So there's demand for yen, causes the yen to go up. So that causes the Bank of Japan to try to do things to stabilize your currency, which further degrades the carry trade, mm-hmm. and you get this repeating process.
Right.
And what you'll see here is asset prices going down, which is which you are seeing. And mm-hmm. I don't know that what we're seeing right now is a factor of the carry trade itself, but it's probably a contributing factor.
Right. Well, because there's still enough spread there, right? Mm-hmm. I mean, I was looking up earlier, and if you look at some of the current Japanese rates, the 2-year is at 0.75% here in Japan, and 4% here.
Right.
Right. So that's that spread you're talking about.
Right.
To keep things simple, can I go borrow money in Japan at 0.75% and just doing nothing else, turn around and invest it in the U.S. and make 4%? Okay.
Right, but the return on the Magnificent Seven over the last 2 months is -20.
Correct.
So that's the thing.
Yeah. Well, and we're lowering interest rates here too, right? I mean, so that's putting pressure on the other side of that as well. So you've got if they use that money to buy our stocks, they're under pressure. If our rates continue to decline like they have over the past 3, 4, 5, 6 weeks, you're compressing that. If Japan has to continue to raise theirs, so as you pointed out, you're sort of narrowing that spread. At some point, doesn't that, when that flips, that seems like maybe that could be a trigger for sort of a flood.
The trigger will happen long before it flips, mm-hmm. because you're dealing, you're on leverage here. Mm-hmm. So you've got this magnification impact as your returns are compressing.
Right.
So yeah, I mean, but again, no idea how much money is in the carry trade, no idea when it's going to switch. It shouldn't have too much of an impact on us because we're not in the sort of things that were probably levered buys. We're not in credit. We're not in large cap growth. Mm-hmm. We're spread out internationally. Most of our fixed income exposure is either in securitized debt or short-term bonds or cash. Mm-hmm. So, I mean, I don't think that the carry trade is going to have a big impact on us, right. But I do think that there are investors out there who it will have a big impact on.
Mm-hmm. Yeah. Kind of like maybe folks that piled all in on the Magnificent Seven the last few years.
Which unfortunately is most 401k investors because, right. Most 401ks are kind of set up to be indexed to the S&P 500 now.
Yeah, yeah. Yeah, lots of concentration in the big tech, lots of concentration in intermediate to long-term bonds.
Right.
All of which maybe might not be the best time for some of those folks.
Sure.
So unfortunately, but this is interesting. I think it's it's a fascinating time because, like you said, it's been decades since really this notion of, well, where do I put the money has maybe demanded as much attention to detail as what it seemingly is doing.
Well, that's all Fed balance sheet expansion and artificially low interest rates.
Right.
interest rates are sort of like gravity on the price of assets. But when they're super low, it makes it look like investing is easy.
Right.
And you can sort of just throw capital at the wall and see what sticks. When interest rates rise, then assets have to start competing with each other for that capital. It becomes much more competitive. And that's what we're seeing. We're seeing asset classes start to compete for capital. And that's when fundamental investors like ourselves really shine.
Right.
Because we're not just buying everything. We're fishing with a line instead of fishing with a net.
Right.
And so we've waited a decade and a half for this type of environment where our discipline is going to start to shine.
Right. Well, and you're seeing that, I think, in how the market correction, to your point, it's really not a correction yet officially. Right. But so far, how the market volatility of the downside has unfolded, it's been very concentrated in really your most probably overpriced equities.
Right.
The things where they've been bought at a good price have held up fairly well. So it's not a situation where everybody is running for the exits on stocks. It's more the rotation out of the things that arguably maybe aren't the best place to be, right?
Yeah, and some of those big tech companies are starting to get a little cheaper. They're not at a buy point for us yet. I mean, I think Google's 20 times earnings, which would be a 5% earnings yield. That's not quite enough for us to dip our toes there. I think Meta's starting to get a little bit cheaper. But if you look at something like Tesla, I think it's still 100 times earnings.
Yeah.
So, I mean, that's got a long way to go before we would even consider it. Not that we won't get there, but I think a lot of other things will become cheaper first.
Yep.
And so, instead of sitting around waiting for that to get to a reasonable point, our stock list is already expanding. We're already starting to see more things that are getting into the price range where we want it to be. And the one thing that sort of hurt us is oil. But that's a longer term investment. And so I'm still comfortable holding that exposure. It's not, it's something that we're going to have trouble replacing over the next decade.
Right.
But it's also sensitive to economic activity. So if economic activity slows down, then you're going to have a price correction there.
And that's a big question mark right now, right? Is what really is going on economically?
Right.
There's probably some correction of data that's coming through. Certainly I think the spillover effects of, government downsizing, what are tariffs going to do? What's inflation going to do? What are consumers going to do? Are people going to get maybe more conservative with their spending habits because of the uncertainty? Who knows?
Well, I've said it here before. The worst possible thing for the market is uncertainty. And so it's almost enough to batten down the hatches just because there's a big period of uncertainty coming in it. Right. So I feel like we're already prepared for this.
Yeah.
And the results are showing it so far. I mean, it doesn't mean it's going to continue. But so far, everything's doing exactly what it should. Our performance is still really good in comparison to what you would have in just a plain vanilla 60-40 portfolio. And, I don't see any reason to change course right now other than adding a little bit more to the international side, which is really the major change that we're making.
Right. Cool. Fun topic.
Yeah.
Be interesting to see when we get to the second and third inning of this whole thing. So I think with that, we'll kind of draw today's episode to a close. Again, thanks for taking time out of your busy day to join. Hopefully you found this enlightening, maybe picked up a few nuggets or some additional context around the noise and the headlines that I'm sure you're seeing out there on the news and in the paper and online and in conversations with friends and family. So until next time, on behalf of Alan and myself, thanks for your time, and we'll look forward to seeing you in a future episode of The Point.
Thank you for joining us for this episode of the Point Podcast, sponsored by Basepoint Wealth. As always, you can submit questions or topics you'd like to hear discussed to info@basepointwealth.com. Be sure to subscribe so you don't miss any future episodes. Basepoint Wealth LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.